Greetings traders and welcome back. Thank you for joining me again for another In-Depth with Chris episode. In today's discussion, we will be talking about speculators. We're going to talk about exactly what a speculator is and how it differs from a regular investor or a hedger, as well as how speculators make money and how they impact the financial markets. We're going to cover all of that and more. And if you are one of my traders that thinks they have what it takes to pass the Gauntlet Mini, then let me be the first to wish you the best of luck on your journey. But without further ado, let's dive on into our discussion today. As far as the word speculator goes, there are a few different definitions that you may find when you are browsing the web. But the most common definition of what a speculator is a person who is buying securities to sell them in the future, hopefully at a nice profit. This is obviously the goal. They don't want to lose money on the deal. The speculator is the person that has a reason to believe that something may be rising or potentially falling, and they're taking action now to re-exchange that action at a future date in order to realize some profits. That is what a speculator is at its core. You may be wondering, well, isn't that the same thing as being an investor? Well, in some ways it is, but the critical difference is that in the case of speculators, they're not interested in holding the securities for a more extended period. We can think of them as a shorter-term investor. Unlike investors, their main reason for buying securities is to sell them instead of retaining them. As with any other form of trading, a speculator seeks to make predictions about future price movements in whatever market they're analyzing, but he or she is only interested in the real price differentials. In reality, there is no such thing as a 100% speculator or a 100% investor to the core. To some extent, every investor has speculative properties and every speculator has investive properties as well, but the difference comes down to the generalized usage of who we're referring to when we say a speculator or an investor. So what does a speculator do? Well, a speculator employs a well thought out strategy which is typically done over a shorter time frame to gain higher profits than traditional longer term investors. The speculator is trying to gain more money than the investor doing it the slow and steady way. For this reason, speculators usually take on more risk because risk is correlated in the trading world with reward, and especially when it comes to anticipating future price movements. They do this to make a large enough profit to offset the risk of what they took on in the first place. You'll find that most speculators are in volatile markets where price movements are frequent. They attempt to predict the price changes and profit from those price moves. Speculators may even utilize leverage to boost potential returns as well as losses. Remember, it's a double-edged sword. However, this is usually a personal choice and not necessarily a speculator quality per se for the entire group. These concepts are why speculators play a crucial role in absorbing excess risk. They also pump liquidity into the market by continuously buying and selling instead of just buying and holding. Furthermore, it's something they do even when investors and other market players are not participating. For instance, after the financial markets crashed following this COVID-19 pandemic that we're currently experiencing, many investors stopped participating in any trades. Instead, they were waiting for things to calm down before they start buying back in. Speculators, on the other hand, were having a field day with all of the volatility. There were speculators making very large profits and losses in that case, while also doing the purpose of serving liquidity to the market. Here's a fun little cartoon that kind of personifies the speculator, the investor, and then the gambler. The speculator says, the price has been going up. There seems to be heavy buying. I will buy it at 200, and then later I should be able to sell it to a bigger fool at 250. Mr. Investor says, after my analysis, I'm quite sure that the real value of the gadget is around $100. It's not a good idea to buy it at the current market price of $200 despite the current market trend. And then Mr. gambler says, oh my god, I need to buy this gadget now before it's too late because everyone is buying, so I must buy, with no logical plan. This is a very rough way to kind of showcase some of the differences, but how do speculators make money? Well, because speculators generally take on excessive risk within a shorter period, they must be able to exert some form of control over price, momentum, and direction. They do so by employing various strategies such as stop-loss orders and position sizing. Generally, their approach also includes keeping close tabs on the statistics of their trading performance to get an idea if they're doing well or if they need to change anything. Speculators are typically sophisticated risk-taking individuals. Despite that they are often confused with gamblers, this is not necessarily the case. However, there is an important distinction between these two. Market participants that use untested methods or execute trades based on hunches or feelings, those are most likely the gamblers like this guy here on the right. They're just going with no logical reason as to why they're going. On the other hand, a profitable speculator usually has put in a large amount of work with a well-executed and proven strategy with a sample size of data to support why they should expect the outcome that they expect, and that's how they're gaining the decisive edge that they have over the gambler in the market. To stay profitable, speculators are typically looking for reoccurring patterns in the market movements. They use this past historical data to justify what to expect when these patterns reoccur again in the future. Trading is detailed work, especially with prices constantly moving, and there's no shortage of variables to consider. That's why each speculator must first develop their own tried and tested way of trading before they go in live for the big kahuna. Speculators have a larger impact on the market than some might be led to believe. Let's say a speculator believes that the price of a particular asset is going up. They can choose to acquire as much of that asset as possible with the hope of selling it at that higher price, but that, in turn, will drive the price up further. Other market participants may see this activity as a positive sign, and doing so could lead to further purchases of the asset. It's almost like the self-fulfilling prophecy idea. If left unchecked, speculator activity can make an asset price go way above its actual value. The result is what's called a speculative bubble. We can see the same on the other side of the trade as well. When a speculator believes the value of an asset is about to decline further and they start selling that asset, it can lead to a snowball effect of causing the asset to devalue past its actual value point because everyone sees the selling and jumps on board with the selling, expecting it to further drop more, and as a result of everyone selling, it does in turn drop more. So the role of speculation on the market is quite an important one. Speculation kind of exaggerates overall market moves and gives a more dynamic view of the market in both directions. In the speculating world, there are four main categories of which speculators tend to fall into. The first category is the bull-bear speculator category. On the bull side of the coin, we have an optimistic view where speculators are entering the market expecting a security price to rise, so they're looking to buy now and sell in the future. If their expectations become a reality and prices rise, then they make money. The bear speculators are quite simply the exact opposite of that. They are the counterparty. They are the counterparty to the optimistic. They are the pessimistic speculators. They're the ones that expect prices to fall, and generally they expect prices to fall sharply. So what they're doing is they're shorting an asset with an expectation that the value of that asset will fall further, and if it does and reality holds true and the pessimistic view is right, then the bears will make their money. But then we have the stag speculators. A stag speculator is generally cautious, especially compared to the bulls or bears. Usually, they focus more on applying for new shares in companies. Then, when the stocks take off, they sell at a premium or at a profit. So, they're looking more so for the opportunity to take advantage of something that's extremely undervalued with a relatively low floor. Then we have the lame duck speculators, which is definitely the most fun one to say in this category. The lame ducks are a term used to describe speculators who are unable to cover their trading losses. That's due to their inefficient trading strategies. This type also includes traders who have defaulted on a debt and are virtually bankrupt. All of these types of people fall into the lame duck speculators category. The phrase originates from the premise that traders who are unable to fulfill their commitments are suffering heavy financial losses and have yet to waddle away from the market. So you do not want to be a lame duck speculator. And then finally, we have the jobbers. A jobber is a professional speculator who is also a member of the stock exchange and performs several essential functions. They are independent dealers in traded assets and typically execute the transactions in their own names. They earn profits through speculating activities and only interact with other jobbers or the broker, never a non-member or a non-jobber. We have mentioned considerably some of the differences between the speculator and the investor, but now let's talk about briefly the difference between the speculator and the hedger. This guy here on the left, he has a pink nose. This guy here on the right, he has a yellow nose. That is essentially I'm just kidding. So the difference between a speculator and a hedger is really down to the fact that the hedger is less interested in the risk that the speculator is, and as such, the speculator stands to make more. Here's why. The hedger is always looking to offset a position. With the hedger, he has a position that's going up, and then he's using another inversely correlated asset or something along the likes to counteract the risk in case his asset that he wants to go up does in fact go the opposite. He's then invested in something that, if his asset is going down, should be going up. That's the concept there. It's basically going against yourself to minimize the risk should things go against you. With the speculator, he's only going up. He's only going up, or he's only going down. He's not doing anything to offset his risk. Now, the positive side of this coin is he stands to gain the maximum amount of money of an asset rising because there's nothing potentially holding him back. In the hedging situation, he's limited to the amount of money he can make because if his asset does go in the direction that he wants, there's usually a good chance that the asset that he acquired to offset his risk will limit and hold back some of his potential gains because it will then most likely be a losing asset or a losing position. With the speculating side of things, there's literally only all correct or all wrong. We don't live in a world when we're speculating where we have portions of correct and portions of wrong like the hedgers do. Instead, we are either correct with our assessment or we are wrong. It's either going to rise or it's going to fall. Even you can become a speculator, and to do so, the way that we want to is generally by becoming proficient with technical analysis as well as fundamental analysis. Being aware of swing trading, pair trading, and utilizing various price action chart patterns are all tools that are commonly employed by speculators. And even hedging strategies can throw yourself into a speculative position even if it is a hedging strategy. There are a lot of ways to get involved with speculating, but the key is to make sure that you're not falling into that gambling category like we initially talked about, and instead you're getting in with a logical mathematical reason for doing so. There are many advantages to speculating, but the three most prominent advantages would be the economic welfare, increased market liquidity, and risk-bearing categories. With economic welfare, speculators provide much-needed capital for young companies to grow and expand. At the very least, they're providing a price support for assets that are temporarily out of favor amongst other traders, and doing so does help drive the economy forward. Then we have increased market liquidity. Since speculators are actively trading all the time, their actions pump liquidity to the markets that they're participating in. No one wants to buy or sell in an illiquid market, so the markets in which the speculators are involved are usually becoming more liquid, encouraging more trading. And then we have the risk-bearing aspect. The risk-bearing is that because speculators have a higher risk tolerance, they are often a good source of financing for companies in general. The disadvantages of speculating can be broken down into two main subjects. The first is the risk of unreasonable prices. Speculative activities can sometimes push prices way above or below their fair values. These price fluctuations may be in the short term only, but they can have long-term effects. Then we have the risk of the economic bubble. The risk of the economic bubble. This just ties to the risk of unreasonable prices. Over time, speculative bubbles can start to impact the overall economy, especially in critical industries like housing, currency, and general trade, as we have seen in the past. In conclusion, because speculating provides liquidity in areas where liquidity is needed, which is just about everywhere, as well as provides financing for those smaller companies that are desperately in need of it, speculating is something crucial in the financial marketplace. It's not necessarily something that is going to be for everybody out there, but it is something to be aware of. It's important to understand how speculating works. A broad portion of you watching this video most likely didn't even realize that you fall under the speculating category, and hopefully not so much under the gambling category. But thank you for joining me again. As always, folks, before you go, please click the like and subscribe button down below. I will be very appreciative of that. Thank you very much, everybody. Until next time, over and out.